Welcome to today's Cancer Charity Support Fund investment talk. My name is Volker Varnholt. I work at PMG and deal on the side with the Cancer Charity Support Fund, obviously, as you know. And I'm your host today, so welcome from my side. Let me begin with a very short story. Two fish are swimming in the ocean, and two young fish are swimming in the ocean, and the older fish is passing by. And the older fish goes, "So guys, hello, how is the water?" And the younger fish go look at each other puzzled and think, what the hell is water? Now, some of you might know this story already. It's part of a very famous commencement speech by the American author David Foster Wallace. And I think this is a very interesting and powerful story because it reminds us that the most important things often hide in plain sight, things that we tend to overlook and that are crucial to our existence, to our lives, to everything. And obviously, the most important thing can be different from person to person, and even to one person throughout their lives, the most important thing changes. But what I can tell you today, also in the context of this event, is that health certainly qualifies as one of the most important things. So what is water? In some cases, or in all of our cases, it's health. Even more significantly, in the absence of health, when you get sick, the most important thing might turn out to be the solidarity and the know-how of people around you. So this event, or let's say the Cancer Charity Support Fund, was launched in 2009 with the spirit of this solidarity, the fight against cancer, together with the Krebsliga Schweiz, Krebsforschung Schweiz. This event obviously is part of this solidarity, and we're here today to try and find donations on behalf of Krebsliga Schweiz. And that's why I would like to thank everybody who registered for today's event and actually made a donation. Thank you very much. That's why we're here for, and we'll hear more about this later on. So thank you. And with that, over to Vincent.
Thank you so much, Volker. My name is Vincent Mounouri, Philanthropy Manager by Swiss Cancer League and the Foundation Fund Swiss Cancer Research. Together with my colleague Nathalie Padlina, also Philanthropy Manager, we have we will tell you something about what we do by Swiss Cancer League and Swiss Cancer Foundation Research. We are working on the national policy setting level, as well as on the individual case level. Of course, the Swiss League Cancer is present in all the cantons, and we give help for directly people who are in touch with cancer or indirectly. We are, as you might know, supported by 95% from privately funded, and that's why it's very important for us to find new supporters, and especially in the financial community. My ask to you, we need you, we need your commitment, and make it simply possible. Thank you.
Thank you, Vincent. Nathalie, maybe you can introduce yourself.
Yes, I'm a philanthropy manager for Krebsforschung und Krebsliga, in charge of foundations and family health visits. And the reason why today we are here is to show you this donation sheet. You have the opportunity to see that sheet. There are two opportunities to donate, either in the emergency fund, in German Hilfsfonds zur Unterstützung von Krebsbetroffenen. These are really true cases, emergency cases, which need support in a fast and no bureaucratic way. Or you have the opportunity to become a long-term partner by investing in the Cancer Charity Support Fund. So we appreciate and we need the support for our patients. If you have questions, we remain longer during the apéro as well. And now we enjoy the event together. Thank you.
Thank you very much. So, in short, thank you. In short, Cancer League is 95% privately financed. You're here, and we hope you will help us finance this. Now, coming back to the two fish I talked about earlier on, with regards to economic prosperity and well-being, you could ask, what is water? You know, what is the most essential thing to keep up economic prosperity in such demanding times? And so I'm very happy to have here with us today Dr. William White. It's very seldom that you have the opportunity to really speak to somebody who's been in the machinery room of global finance, who knows and is better connected and networked than most people that you might know. William White has been working all his working life in central banks and central banking. He's been a central banker to the central bankers at the BIS in Basel. And up until recently, he's been the chief economic advisor to the OECD in Paris, a position that he retired from, as I understand, in April. And we'll do something very unusual here. So on the one hand, we talk about the very big picture, what is water of our economic prosperity, and we'll mix it up with some input from a completely different point of view. Paul McNamara, he's English, he's from GAM. He has been trained at the London School of Economics and has been in the business of spotting, avoiding and scouting crisis situation and distressed situations in emerging markets and emerging currencies for the past 20 years. He's got a very long and very impressive track record in this asset class. And so we'll mix up the big picture with the more tactical investment views that they have. So thank you, two of you. And I'll be making my way now up on the stage. Before I go, I would like to start. My first question is to the audience. So with a sign of hand, who amongst you is of the opinion that over the next 2 to 3 years will have a sell-off comparable to the 2008 sell-off? 1, 2, 3, 4, 5. Okay, so that's a minority, I'd say. So I'm assuming that the rest of you are in a very good mood and very optimistic, and we'll hope to change that over the next 45 minutes.
We can fix that.
So have we all switched on our microphones? Great.
Can you hear me?
Yes?
Yes.
Super. Perfect. So, William, what does it take to be able to spot economic crisis?
Well, the first point I'd make, I guess, is that it's easy enough to see the underlying problems and the imbalances building up. The really difficult part, and this is where I think you should defer more to Paul than to me, is to know the timing of when it's going to happen. I'm very much of the view that most of economic theory is actually misguided, macroeconomic theory. It's, they got on the wrong path about 100 years ago by assuming that the economy was like a machine. You know, it was understandable, relatively simple, understandable and controllable. And the underlying reality is it's not. The economy is not a machine. In the jargon, it's a complex adaptive system like so many others in nature and in society. Okay? And it's the interaction between the bits that's really important, and that's missing from standard macro. And what we know about those systems is that they break down all the time, according to a power law, so that you can look forward to crises on a regular basis, small ones more regularly, big ones less often. And they often throw out highly nonlinear results. So you get very bad outcomes. So I'm thinking, for example, of 2008, the World Economic Outlook, the WEO, in May of 2008, forecast for the advanced market economies in 2009, growth would be 3.7% positive. And it came in at minus 3.6. Okay? So a huge forecasting error. And in a certain sense, that period reminds me of the current period in that there was an awful lot of optimism. And I think this goes back to a kind of psychological propensity that the psychologists call disaster myopia. You know, that we're totally unable, and this is through a process of evolution, totally unable to contemplate really bad things happening. But the underlying reality, talking about the charity that we're supporting here today, really bad things do happen. And it's very important to prepare yourself for those events. So today, as I say, when I look at the objective signs of Houston, we have a problem. I guess the first thing that I'd say is that we've had 10 years of so-called recovery. And yet, in many countries, we're not yet back up to pre-crisis levels of output. It's all been very, very slow. In spite of this massive monetary stimulus. And the upshot of the whole thing, because of this monetary stimulus, is we've had a huge further buildup of debt. So you think about, this has been a crisis period, right? 10 years of recovery. And this is a period of deleveraging. Well, it hasn't been a period of deleveraging, it's been the very opposite. So when you look at the debt to G&E ratios, the non-financial debt, which is corporate debt plus household debt plus government debt, the latest BIS numbers I looked at show that globally, those debt levels have gone from 192% of GDP to 232% of GDP. And the problem of debt, which previously had been constrained, as it were, to mostly private sector in the advanced market economies, is now everywhere. So the sovereign debts in the advanced markets are going way, way up. The corporate debts in the emerging, well, Paul can speak more to this than I can. And I hope I'm misinterpreting the numbers. But the corporate debt, particularly in China, but in many other countries, is going way up in the emerging markets. So now it's a kind of global problem. It's not just a relatively narrow problem of excessive debt. And that sort of really concerns me. And when I look at the financial markets, up until just quite recently, it seemed to me you had the same kind of everything's going to be okay in the financial markets as you saw in 2007 and 2008, which was the corporate spreads are way in. Italy is financing itself more cheaply than the US government. The VIX was very, very low. House prices are very, very high in most places. Maybe, Switzerland, they've always been very high. But in Toronto, in New Zealand, in Auckland, in Sweden, and all the Nordics, house prices, household debt, never been so high. So there's a lot of things out there. The precise timing, the honest truth is, I have been no good at that at all in the past. And there's a very old line, and I'll finish with this. Herb Stein, used to be at the American Enterprise Institute many years ago, basically said, if something's unsustainable, it will stop. And Rudy Dornbush, who's sadly also dead, said, yes, but it will go on a lot longer than you anticipate. And that's basically been my problem. So I think there's a big problem coming, whether it's tomorrow or whether it's 2 years down the line. My track record is not good.
Can you time a crisis? Is there any way? How do you look at these things, Paul?
In emerging markets, I think in a fairly narrow sense you can. I mean, Turkey, anybody who heard me speak for a couple of years has been very negative on Turkey. The key thing I think I'd address, though, is slightly different. The real trouble as you come into a crisis doesn't tend to be in the stuff that's risky. So don't worry about Turkish equities. You know, during the dot-com, it wasn't pets.com that was the real trouble. The real problem is the stuff that people think is fairly safe. So, yeah, you lost money in EM equities in 2008, but not in any unprecedented way. Where you got murdered was stuff like subordinated financial debt in the G7. The subprime securities which did the most damage were the AA and AAA tranches, the stuff that people thought was safe with just a little bit more yield. It wasn't, you know, the rubbish, the equity tranches. People knew they were trash, just as people knew pets.com was a problem, or eBay in 2001, or in my area, Turkey or Ukraine or Venezuela. Nobody gets leveraged up against that stuff. Where you want to worry most is the single A, the double A. A nice little factoid is that you know, the 100-year Argentine bond that was issued, I think, a year and a half ago, you've actually lost less money on that than on 30-year treasuries or 30-year General Electric GE paper since that was issued. Now, I'm trying to, you know, my day job is I run an emerging market local currency fund, Turkish lira, Russian ruble, Brazilian real. So if I say that's not what you really need to worry about, I'd understand a certain amount of skepticism. But what I would say is the stuff to worry about is the stuff that's probably rated BBB, single A, double A at the moment. The stuff that's safe with just a little bit of yield pickup, the stuff that the smart guys buy. You know, just as in the dot-com boom, the real damage was done by Cisco, by Nortel Networks, and the other one. Not by the trash, that, you know, the stuff that the guy who actually did the door when I was working at Julius Baer was getting into. I think eBay was his top pick. You know, it's not Bitcoin now. It's what I'd worry about. I think Italy, as an EM manager, just as we looked at Greece in 2009, thought, who's going to buy that? I think, you know, Italy. Obviously, Volker was unkind enough to refer to me as English. I'm identifying as Irish now. I mean, I don't. You know, it's, you know, sort of 2 years ago, I was doing these things, and I was saying, look, you really need to worry. We might just vote to leave. And people said, no, nobody's going to do that. And then we did vote to leave. There really is no bottom to the stupidity by which policy is being run in the United Kingdom at the moment. The UK is not a safe store of value. My best investment has been an Irish passport. But sorry, I'm rambling. The key point, I think, is, you know, you can see crises coming. I don't entirely agree on the corporate debt in emerging markets. I think it is very, very much a China problem. When you take China out of the statistics, although the amounts of EM debt go up like this, the ratios to GDP, or more important, to exports, look reasonably stable. But emerging markets are a spectrum. I think, you know, if you're building a portfolio now, you certainly want to look at putting money into Turkey. And I can promise you that's not something I've said for a couple of years. I think Argentina is also interesting. The stuff I would worry about are actually places like Central Europe, you know, the four, Poland, Czechia, Hungary, and Romania. I think there's worrying stuff in India. It's not you know, Venezuela could be a very interesting investment over the longer term. I think Turkey, I think Argentina have potential because they're all being invested in with people who can see both sides, not people who think that they've got you know, effectively a US Treasury, but with a little bit of extra yield.
Now we're talking with somebody who's been in policy making analysis and advising for all his career. Before we started, we had a small conversation about you debating with Alan Greenspan before the last crisis, and you made the point that asset prices were inflated and the central bank actually has a role in monitoring that and counteracting if necessary. Tell us a little bit about the experience of being an outsider in a mainstream discussion. That must feel quite uncomfortable to have an opposing view on the mainstream, and what your analysis is today.
Well, it was certainly uncomfortable to have a different view than Alan Greenspan in 2005. I was just thinking when Paul was talking about, buying Argentina and Venezuela and whatever, but it seemed to me the common theme, if I got it right, was these are places that in a certain sense have already experienced the crisis, okay? So they've gone down and you buy on a big dip. But I think your warning was that there's an awful lot of stuff out there that sort of still looks pretty good, but that maybe the big dip is yet to come. And so keep your powder dry. There's an equivalent, we'll test your English here. Mark Twain, about 100 years ago, said, "It ain't the things that you don't know what get you. It's the things what you know for sure what ain't so." So it's thinking that you know the truth and betting on that often sort of gets you into trouble. And my worry is that the central banks really have been doing that for really a long period of time. So if you think about George Soros, to go back to the 1980s, maybe one should, but I'll only go back as the stock market crash of 1987, and the answer was print the money. And then we had the property collapse in the Nordics and Japan in 1990. The answer was print the money. 1998 was the same, 1996, Southeast Asia, 1998, 2000, 2007. It's always been the same reaction, which is we need easier and easier monetary policy. And so the upshot, when you go back over that 20-year period, is what you see is not just nominal rates, but real rates going down and down and down. And I might say as a corollary, because the governments were having the same sort of asymmetric approach to their policies, okay, they never sort of cut the deficit as much in the upturn as they raised it in the downturn. So government debts have been ratcheting up and up and up as the monetary conditions have been easing. And this has really sort of set and everybody thought they knew what they were doing. But the problem is that they've not taken into account the cumulative buildup of all of these imbalances. And in part, it's because, and I go back to what I said right at the beginning, the standard models that all these people use, okay, the sort of the workhorse of the macro community at the moment is what they call the dynamic stochastic general equilibrium models. These models have no money in them. They have no credit in them. They have no bankruptcies in them. They are, from that perspective, totally bankrupt as a theoretical apparatus for understanding what's really going on. But people think they understand what's going on. And so all of this financial stuff has just been basically put to the side. We needn't worry about spreads going in, about the VIX going down, about pension funds and insurance companies that are having to change their business model towards more risky investments because they can't make money on a standard portfolio. All that stuff is unimportant. Okay? I think this is fundamentally wrong and the source of the problems that are coming down the road. Because all of this stuff is cumulative. Okay? When I talk about debt, okay, it's cumulative. So you've had all of these cycles that have encouraged the buildup of debt and all these other imbalances. And each passing cycle, the stock situation gets worse. And that's the thing that I'm concerned about. But precisely when, as I said before, or precisely where, that's sort of in the realm of the unfathomable. The only point I'd make finishing up is that I talked about these complex adaptive systems. They always break down. They do so in a highly nonlinear way. One of the other things that's characteristic is that the crisis has it, in a certain sense, the trigger is unimportant. Okay? And it can come from any place. It comes out of the shadows, as Leonard Cohen would put it. Okay? It always comes out of the coulisses. And you should be looking for the unexpected. It won't come from the same place that it did the last time. Something else will trigger it. But the real worry is it's the whole system that's unstable. So that when something starts to go, you'll see the repercussions everywhere.
That's too late, I guess. But the policymaker is in a position to do something in advance. How would you look at there's a German economist who tried to put a positive twist on a crisis, Schumpeter with his creative destruction. Would that be a recipe for Cartesius?
Well, the thing about Schumpeterian creative destruction is it really is sort of premised on the idea that it's an ongoing process, so that you have ongoing little crises. Okay, so you don't get the buildup of all of these imbalances. What we've done over the course of the last 20 or 30 years is every time that there's been a prospective downturn that, of course, the politicians don't like, the policymakers have stepped into it, and this is all part of the accepted wisdom, is that we've got to stop this thing out using either fiscal or monetary policy because recessions are bad. Well, the fact of the matter is little recessions are bad, but they're not as bad as really big recessions, crises, which is what you get when you allow the little problems to build up and build up and build up over time. And getting that thought into the policymakers' heads, that a downturn is actually good for you for all sorts of reasons. One, it avoids the cumulative buildup of problems. But secondly, it fosters the creative destruction that Schumpeter was talking about. Getting that thought into people's heads is not going to be easy. It's too late now. I mean, we've been on this path for 30 years.
In emerging markets, we have a couple of policymakers who obviously don't care too much about the general prosperity of the everyday people, and they have some major creative destruction going on. How can you suggest to us to invest in places like Turkey and Venezuela?
Well, I mean, the best take on creative destruction, this idea that you have bankruptcy, it creates cheap assets, it creates the foundation of the next, it makes people unemployed, so you get skilled labor cheap. Creative destruction sounds like a terrific idea until it happens to you. Politically, creative destruction, liquidation is terribly unpopular politically, and that's why democracies throughout the world have generally steered well clear of creative destruction, by which we mean liquidation. Since about the oil crisis, the only generator of GDP growth globally has been debt. I mean, if you're smart like the Germans, you sell to the people who are borrowing. If you're more like the British or the Irish, you borrow like mad yourself and you generate GDP growth like that. The problem with this is what creative destruction requires is liquidation, is that at some point, whoever's on the other side of the debt doesn't get made whole. If you lend somebody $100, if you put $100 or francs or pounds in the bank, you don't get £100 back. That's what creative destruction involves. It means that people who are owed money don't get the money back, which means that wealth is destroyed. Now, all the precedents that we have show that the recession that you get in an actual liquidation is appallingly tough. If you look at the US depression of the 30s, if you look at Russia in 1998, if you look at South Korea in 1997, these are much, much steeper declines in GDP than anything we've experienced, sort of over the last 12 years or so. But Korea, I think, is a particularly good example. If you look at the chaebol went from, Samsung just used to make kind of rubbish cars and rubbish computers and rubbish stuff. Now they're a cutting-edge global firm. And whereas Daewoo are gone. Liquidation works, but it's politically incredibly painful, very destructive. The burden tends to fall unfairly, not necessarily on the people who inflicted, who did the most rash lending. There isn't a justice aspect to it. It works as an economic process. I think we're going to end up with a major liquidation, possibly in the developed world, certainly in China at some point, across maybe some of the emerging markets. I think Turkey, it's already well in progress. There's a great opportunity there, but the politics are very, very difficult. And again, as an Englishman, I'm very aware of the adverse collection, of a very upset electorate. So I think we're all on the same page about creative destruction and the effects of liquidation, but don't underestimate how painful and how chaotic the liquidation phase can be.
Is that a reason why central banks don't want to assume responsibility over the asset price bubble that is developing every once in a while? You had the debate with Alan Greenspan. What was the pushback like?
Well, of course, the central banks don't want to take responsibility for the increase in asset prices. And I mean, you can see it at the moment. There's a big debate going on about the distributional implications of ultra-easy monetary policy. And on the one hand, you've got all sorts of people who are saying they've bid up, equity prices have risen virtually everywhere, high-yield assets prices have risen virtually everywhere. Who holds these things? And the answer is overwhelmingly rich people. So in terms of wealth distribution, monetary policy has made the contribution. Well, the kickback from the central bankers is they've actually kept employment up, and employment is the most important thing for equalizing incomes, and so therefore they've done more good than harm. And there's an element of truth on both sides. My worry, and I don't think it's any different from what Paul's saying here, is that if you're constantly leaning against little downturns, which I think can have unpleasant side effects, including liquidation, but if you're constantly leaning against it, you're going to wind up having a bigger problem down the line. And I've made allusion in the fact to forest maintenance. Okay, I go back to these complex systems are all the same. Okay, forest maintenance. In the United States, up until the 1930s, if there was a forest fire, of natural causes, they just let it burn out. And then after the 1930s, they changed the policy, so they put out all the fires. And the bottom line was that by, 1987, I think, they had a huge fire in Yellowstone that they couldn't put out. It was impossible because the buildup of undergrowth over the space of something like 50 years had grown so great, it became impossible to do anything about it. And that's the real worry that I have at the moment, is that we're in a situation where we got a problem, of all of these imbalances. They start to come unstuck. And then the question is, what can the policymakers do about it? And the answer is interest rates are already at 0, so they can't really go much more negative. We've got all of this stuff like qualitative easing, quantitative easing, forward guidance, Operation Twist. We don't know whether it works or not, and we don't know whether it will work in a cumulative way. Who's prepared, Swiss National Bank, to increase the size of your balance sheet even more in the context of a downturn when it's already so big? Monetary policy, not so clear we've got much room for maneuver. Fiscal, as I said before, big increases in sovereign debt virtually everywhere outside of Germany. So there's going to be a lot of pushback on using more fiscal in the event of another downturn. General liquidity support. But what's not commonly recognized is that the ECB is under no obligation to provide liquidity support to any individual country in the Eurozone. In fact, they're not supposed to do so in a certain sense, at least not on a lasting basis. And there's a recent book out by Hal Scott of Harvard who points out there's at least 6 provisions in Dodd-Frank that will prevent the Fed from doing what they did the last time. And in addition to that, back to emerging markets, maybe it's a problem, maybe it isn't, there's $11 trillion worth of liabilities issued by people who don't earn their money in dollars. $11 trillion. Now, when the crisis comes, there's going to be a big shortage of dollars, just as there was during the crisis in 2008. We talk about it as a subprime crisis, but increasingly, when you read the literature, people are saying, no, it wasn't really a subprime crisis. The real problem was the European banks were shorted dollars to finance short-term, the longer-term dollar assets that they had in the US. It was a maturity mismatch problem, and it was a currency mismatch problem. And we've got exactly the same thing in spades. Now, last time around, the Fed lent, both through the discount window and through the swaps, they lent $1 trillion to people who needed it. My question here, as we look at the crisis, what are you going to do when it happens? Is the Fed going to lend up to, expression, pony up to the bar, okay? Look at me, the big man in the bar, I'm going to give you $2 trillion, take it away. One, will the Fed do it? Because they're not obligated to do these swaps. And secondly, will Congress let them do it? Because you're all a bunch of unreliable foreigners. So we've got some big issues out there, and I'll just finish on this note too. One of the other things about the unintended consequences, about interfering constantly with these downturns and allowing this sort of big buildup of problems, we saw what came out of 2008, and the answer wasn't just an economic consequence, it was a political consequence. That was the roots of the polarization and the populism. And my question is, when we get the next downturn, what happens next on the political level? And that's something that I think is profoundly worrisome. And when I was talking to Alan Greenspan and the people at the Fed, they would say things like, we're leaning against all these downturns, and the gains that we get, okay, are greater than the discounted costs from the big downturn that might be the consequence, okay? So you just do the maths, and the costs are greater than the benefits are greater than the discounted costs. I say, fair enough, but what about the politics? If we get into a world where you've got this polarization of the sort that happened in the 1930s in Central Europe, and historically it's happened in many other places as well. There's now a developing literature on all this stuff. So I have some real concerns, not just about the economic consequences of what we all have been doing, but the political consequences.
Well, I'd agree on the politics. I mean, the one thing that's true of any crisis, whether it's a liquidation, whether it's what we've just seen, where the central banks steer us around, is that the pain is felt at the bottom. It's the poor what gets the pain, and that's what's made, I think, the politics in the UK, in the United States, in various other countries particularly toxic. Is that the way of offsetting the crisis has been to bid up asset prices, to bid up wealth. Wealth, much more than income, is very unequally distributed. I think, and forecasting is tough, especially about the future. But what we saw in the United Kingdom a few years ago, it seems to have been withdrawn, is that instead of the central bank printing money for quantitative easing, it was the British Labour Party was suggesting people's QE, where you money finance the deficit, which is something that obviously since Germany in the 20s has been toxic in the developed world. And I think that is a very likely path from here, especially with actors such as Mr. Trump, such as Mr. Corbyn in various countries. I suspect I'm less inclined to believe in a strong dollar as the outcome of this. I think given the balance sheet of Europe versus the United States, I'm less convinced dollar strength will be part of the crisis. But I do think monetary financing is firmly back on the political agenda now.
Now, in emerging markets, one of the contributors to the fact that the amount or the number of crises in emerging markets since the 80s has halved or even less. There was constantly a crisis somewhere going on in the old days. This doesn't happen anymore, and one reason is independent central banking, if I'm not mistaken.
I think less independent central banking in the sense that you now have floating currencies.
Floating currencies.
Adjustment is a painful process. The key political part of any adjustment process is allocating the loss. Is it bondholders? Is it depositors? Is it equity holders? And if you allow a big depreciation, then you're allocating the losses to people whose reference currency isn't the domestic currency, so foreigners. Floating exchange rates work, but they do inflict losses. And sorry, I'm still trying to sell a local currency fund. It's part of a loss allocation mechanism. You're not escaping losses. You're just allocating them in a more efficient way.
Mm-hmm. Now, famously, Paul Volcker was one of the heroes of independent central banking, combating very high inflation and raising interest rates to very unpopular levels. these days, I'm a little bit surprised if you look around that even the President of the United States starts to have some clear message for his central bank. There's some intervention in Turkey. Even Italian politicians are trying to pressure their central bank. So there's something going on that is a dogmatic shift from the old wisdom of having an independent central bank.
Mm. Yeah, I suspect, I mean, I'm just trying to think my way through this, but I suspect that the political figures are now seeing more clearly, perhaps than they ever did before, what the implications of a downturn would be. And they are becoming ever more desperate to avoid that outcome, even at the cost of a still worse outcome further down the line. So they're pulling out all the stops here in order to ensure that tightening monetary policy doesn't become the catalyst for the downturn that everybody's worried about. So this is the debt trap thing that my colleagues at the BIS often refer to, which is that the debt levels and the imbalances are now so great as they've accumulated over the last 20 or 30 years that in some fundamental sense you really don't want it to continue anymore. You want to stop it out by going back to something more or less like normal monetary conditions. But what you also know is that the very process of doing that may be the trigger for the problem that you're trying to avoid. And this is the so-called debt trap. So you can't stay where you are, but you can't go someplace else either. So you see the central banks now in the big countries, well, not the big countries, the biggest country, the United States, more and more emphasis, when you listen to what Jay Powell has been saying, there's more and more emphasis on the financial side, which he was worried about 5 years ago. You know, read the minutes from 5 years ago from the FOMC. He's been worried about this stuff for a long time. And now it's sort of surfacing that it's not just inflation is going up in the States under the influence of the fiscal excesses of the Trump administration and the trade wars. It's not just inflation's going up, but there's a growing recognition that these imbalances are a problem and that you should do something about it. But it implies then, because of the trap aspect of it, this is going to be done in a gentle, you know, that you can see they're sort of feeling their way through it. And whether they'll succeed or not is, I mean, I can tell a story. I mean, and Paul could tell a story too, I'm sure, about how we might just wind our way through this. But I can also tell you a story where, you know, the Fed gets behind the curve, the markets lose patience with the imbalances and sort of say, you're all turkey now, I'm out of here. So it's possible that we can get through this, but it's a very dangerous place, I think. And they're right to be very cautious in terms of what they're doing.
Excuse me. The United States, I think, is unique in showing some signs of moving out of kind of the deflation trap, the idea that monetary policy has no traction, that we're beginning to reach the point where you're getting inflation picking up, nominal growth beginning to pick up, and it's making a smooth exit from that, you know, keeping inflation under control whilst at the same time allowing the growth to continue, which is a very narrow path. Now, since 2008, we've been in this zero interest rate liquidity trap environment globally, and that is a very permissive environment for monetary policy makers, that you can create money pretty much without limit, without having immediate consequences on goods prices, where asset prices might be storing problems up for the future. The United States is a test case for whether we can make a successful, smooth exit from a liquidity trap without triggering some sort of asset price consequences. It's not a problem that seems to me to face any other central bank in the world. Certainly not, you know, in Japan is doing quietly reasonably well, but it's still, I think, in liquidity trap territory. One issue, and actually I'd be very interested to know what you think, is that a very significant part of government debt across the world is now owned by central banks. And clearly the temptation will be, you know what, we'll just cross it out. You know, all the gilts owned by the Bank of England, all the treasuries owned by the Fed, all the JGBs owned by the Bank of Japan can just be written off. And then suddenly, debt problem gone away.
Well, it hasn't. It hasn't. Think about QE. You know, basically what's happened here is that the central banks have bought in long-term maturity government debt, and they've replaced it with the shortest maturity government debt you can issue, which is central bank liabilities. So when you talk about sort of netting out, okay, basically this is, you might be able to sell it to the public, but the bottom line is, if the central bank says to the government, you needn't pay me interest on all this debt that I hold, okay? Write it off, put it down to zero. Well, all they're doing is that they're saying to the government, we will not be giving you the seigniorage, okay, that we have been giving you as the central banks remit their profits back to the government, okay, in the future. The thing is a total wash, okay? That you can't net out the government debt as long as you consider the central bank to be part of the government, which it is. Okay? All you're doing by doing this netting between the central bank and the government is you're basically explicitly recognizing that the debt that the government owes to the private sector, okay, which is the holdings of excess reserves at the central bank by the private banks, okay, that you're basically saying the long-term liability is gone and it's been replaced by a short-term liability, which is the most dangerous form of liability there is. And what I would see sort of coming out of either that or what we already have is a process in which people systematically begin to understand the extent to which the government is actually being financed by central bank money. And there's two sets of literature that have to do with this. One of them, there's a very famous article that was written in the early 1990s by Tom Sargent and Neil Wallace. It's got the title, Some Unpleasant Monetarist Arithmetic. The title says it all. You know, it's very easy to get into a situation where the fiscal situation is so bad that as the monetary screws get tightened and the debt service requirement goes up because all the interest rates are going up, that people start to take fright and they basically say, I'm out of here, and they go into Swiss francs or whatever else it might be, and then we have a huge problem. And there's an old friend of mine, Peter Varnholt, whom some of you may know here from the University of Basel. Peter wrote a book about 20 years ago, which has just been reissued, which is called Monetary Regimes and Inflation. He's got a whole chapter in there on hyperinflation. And it all starts off with the government's in trouble. And the central bank comes to their aid. And in the end, it turns into a disaster, hyperinflation in many instances. And that really is the worst case scenario. And you were mentioning Japan. I had an article in the FT here about 2 years ago. I worry about Japan. But if the interest rates start to go up in Japan, the government currently is being financed, 40% of total government expenditures in Japan are being financed by the Bank of Japan. And interestingly enough, this is Peter Bernholtz's magic number. And he's very humble, as indeed Ken Rogoff was about his 90% number, remember? You go back and you look at the original, these people were very humble about what they were saying in terms of inflection points, whatever. But it is interesting that 40 is Peter's magic number about where you should really start to worry. And the Japanese are already there. So if the interest rates do go up to anything like normal measures, normal levels, with a debt to G&E ratio of over 250%, okay, and the demographics sharply declining, I think the Japanese are also going to have a problem to try to, you know, so fulfill between the two solutions, you know.
Okay, let's do something more positive. Paul, what's your view on China?
Yeah. China has too much debt. Private sector credit, 250% of GDP. A significant amount, a part of it is kind of shadow banked, you know, which is a combination which tends to be problematic. The big positive of China is that there isn't really a significant foreign element. It's not like Asia in 1998, where there, a lot of money, especially petrodollars, had come in from the Gulf, and so there was a big FX mismatch there. In fact, the Chinese financial system, the loan deposit ratio is about 1, whereas typically the financial institutions which get into trouble, Northern Rock, Lehman Brothers, the Irish banks, have a very significant chunk of non-deposit financing, of wholesale financing. You get a banking sector crisis on the liability side when when a bank can't borrow, not on the asset side. If you look at Japan, if you look at Italy, an insolvent banking sector isn't a huge problem or an immediate problem, an illiquid banking sector, and the channel by which the Chinese banks become illiquid and you have a full-scale crisis is quite hard to see. But what that does mean is that you get something that looks more like Japan or Italy, which is a very long period of very slow growth. Sort of 6% levels of real GDP growth are not remotely sustainable in China. We have to move to, I think the consensus is that we get a recapitalization of the banks. The sovereign balance sheet is reasonably clean, but the longer-term equilibrium is that growth in China is going to be much lower for longer. Big implications for commodity markets and the rest of emerging
Everybody
markets.
else, yeah.
Yeah, it's got knock-on effects all over the place, but it's not going to look like Asia 97. So that's the cheerful read.
Okay. So now I'm almost certain there are some questions in the audience, but before we go there, I'd like to repeat my question to the audience. So with a sign of hands, who is of the opinion that within the next 2 to 3 years, there'll be like a 2008 sell-off event? 1, 2, 3, 4, 5, 6, 7. Okay, that's not much changed. Okay. Okay, so maybe some questions from the audience. Somebody has to ask the obvious question, where is gold going? Anybody? Paul? Sorry. Yeah.
Where's gold going?
Well, maybe you want to lose some words on the potential weakness of the US dollar. In Europe, we still have stable household, balanced household, not household deficits, like $100 billion per month in the States. We don't have a debt load of 21 trillion US dollars, held by 50% by foreigners who still believe that there is some value. But from a Swiss point of view, the US dollar has devalued 90% in the last 50 years plus. So we have to calculate with a devaluation of the US dollar by of 3%. If you can maybe lose some words on how long will the US really be able to rely on stupid foreigners?
Did you understand the question?
How stupid I guess the question is how stupid the foreigners are. What was really surprising to me, looking at the crisis of 2008, for example, there's a lot of people out there like Nouriel Roubini, for example, who forecast a crisis, but expected that the trigger would be these current account imbalances, that everybody would look at the English-speaking countries, particularly the United States, and so you've got these huge internal debt problems, and you've got a growing external debt problem, and therefore you're the risky one, and I'm out of here. I'm out of dollars. So the dollar would go down and everybody else would go up. Well, what actually transpired was the very opposite. That not only was there this problem of the global dollar shortage, but there does still seem to be this tendency that whenever anything goes wrong, okay, even if it's in the United States, the refuge currency is the US dollar. And we saw this in 2008. We've seen it more recently. I guess the question would be, and I don't really have an answer for it, is what happens this time around, because everything is cumulative. Will the dollar continue to be the refuge currency? A lot of people feel it will be because there's no other place to go. At a certain point, however, I mean, you do get back to the story I was telling about Japan, is that the dollar is the reserve currency. But at a certain point, perhaps people will start to say, I think the euro, the Swiss franc, whatever is a viable alternative, and I'll at least try to get into that other currency. And even though, how can I say, there's not a lot of there's not a lot of reserves held as euros or Swiss francs, etc., relative to reserves held in dollar form. It's the it's the willingness to get out of one currency into another that will determine what happens to the values of the currency. And it's not hard to tell a story of the whole thing collapsing and the dollar no longer being the refuge currency. And then but then I think the honest truth is we'll have an even bigger problem because there'll be no, as it were, base for the operations of the international financial system because the dollar still is the basis of the international financial transactions. So that would be an even more worrisome story, to be honest.
Any other questions?
First of all, thank you for a great conversation. Very, very helpful. What are your views on not so much gold, but cryptocurrencies? Could that be the trigger for the next big crisis, or are you rather positive on these?
I think it's very hard. Cryptocurrencies strike me as an answer in search of a problem. I mean, the only sort of real use they seem to have is sort of purchasing drugs and guns on the dark internet, which, while obviously very handy, isn't the basis for a future. Without a really compelling use case, look, I'm an emerging markets economist, so my opinion isn't really worth very much on this. It's what problem do they solve? Because transactions aren't particularly fast. It's easier to use Visa or PayPal or anything else for moving money around. Is relatively anonymized because transactions can still be traced through the blockchain. Relatively anonymous transactions sufficient to establish an independent store of value. Personally, I'm skeptical, but again, with the proviso that I don't really know what I'm talking about.
Yeah, I think it goes back to the last question, that if you had a situation where there was a kind of turning point with respect to the dollar, and people were looking around for what are the alternatives. Well, clearly, in that environment, you'd expect to see gold and metals and, going up in value. But you might also find people would say, I know these cryptocurrencies takes ages and ages to sort of do transactions and they're not really a store of value. But in these circumstances, I see the value going up. And that's where I'm going to put my money. That this could, as it were, exacerbate the problem associated with the loss of confidence in the US dollar. But this is really sort of in extremis, it seems to me. A closely related question, and I don't have any answer on this, I know there's a big debate about it, is whether the central banks themselves should be issuing digital currency. And Stefan Ingves has been going on about this quite a bit in Sweden. Because, of course, the private sector has actually, because it's expensive to use currency. The banks have got to, you ship it in and ship it out, and it costs a lot of money. So in Sweden now, they've basically gotten rid of currency. I think they're down to 4 or 5% or something of all the transactions are being done with hard cash. And of course, I guess that suits them from the drugs and, whatever perspective as well, to say nothing of the guns. But a lot of countries are now starting to think about that. But as soon as you do, and my thinking is not complete on this by any means, one of the problems with the central banks offering digital currency is that whenever things start to get really sort of tough and people start to worry about the banks, then you might see this huge flow of money out of the banks into the digital currency issued by the central banks. Well, then the next thing to say is that's a real problem. Why don't we take away from the banks the capacity to offer something that we commonly consider to be money, which is current accounts that are immediately exchangeable for notes? Okay? Why don't we take that away from them, and then there can't be a flow out of the banks into the central bank? But that totally changes the business model. This is narrow money. This is Volker initiative. Okay? You're sort of driven in this direction. So there's big implications of some of these things. So people are still sort of thinking their way through them.
One more question. Yes, sir?
I wonder if your question of the 2 years horizons of a big downside would be the same answered if you ask for 10 years time frame. And on those time frames, are central banks still able to leaning against?
I mean, it's, I'm going to say my track record on the timing. I go back to 1997 with the Asian crisis, and I thought that all of the hot money that went into Southeast Asia, that these people would wisen up and stop doing this kind of speculative wholesale investing. And the very opposite happened. The money did leave Southeast Asia. It went to Russia and Brazil. And so it's continued ever since. So in a fundamental sense, my fundamental error has been the incapacity to see the success with which the central banks could keep on kicking this can down the road. Okay? The imbalance is getting bigger, the stock debt getting bigger, and they've done it enormously successfully up until now. Could they do it for another 10 years? It's not impossible. It's not impossible. But to me, as you sort of look at the way the thing is sort of creaking, I think it's improbable, but again, as I say, my track record is terrible.
So on this relatively positive note, I again thank you very much for being here today. There's a little buffet, as always, available. So if you have some time to spend to network and discuss with the speakers, you're more than welcome. Otherwise, just have a sandwich and have a very good day. Thank you very much.